there's an article in, I think it was in Bloomberg, about folks trying to figure out how to get a lawsuit filed against Binance. And the problem was that they didn't even know what entity to sue. It's not clear who owns what and what owns the other and who the ultimate look-through ownership structure is. And it doesn't mean that Binance is guilty of anything, but the article was just showing how there was a U.S. investor who lost $1.2 million who wanted to file a lawsuit, and they have every right to do that. Couldn't even find the corporate entity to actually file this lawsuit against. So if that's what's happening in a $1 trillion market, there's
it's going to be a lot of pain.
It's a lot of oversight.
Hello and welcome to Money Talks. In today's video, Chamath Palihapitiya, who is a popular venture capitalist and founder of Social Capital, gives a market update about Fed's decisions, labor force, job openings, and the ongoing crypto collapse, and the chances of a recession. Make sure to stick around till the end of this video where Chamath Palihapitiya reveals how crypto crashes are impacting the global economy and why next 3 to 5 months of CPI will be really bad. So, without wasting any time, let's dive right into the video.
Wow, there's a lot to say, so bear with me for a second. But the thing that you have to do before you talk about what is happening now, I think it's probably useful to go back, and you have to really start at the end of the great financial crisis. And the reason is there was a bunch of people coming out of the GFC who confused what the US government and some European governments were doing. At the time, there was the risk of a huge financial contagion. And so the US stepped in and the Federal Reserve started to use their balance sheet to buy toxic assets, right? And the ECB did that, and I think Japan did that as well. Anyways, a bunch of banks did it. I mean, a bunch of governments did it. And then there was this body of pseudoscientific economists who coined this thing called modern monetary theory, which basically said, hey, you can keep printing money and introducing it into the economy to smooth things out and to actually drive long-term growth. And it turns out that a bunch of government officials fell for it. And if you fast forward to 2022, so 14 years later, governments around the world had printed something to the tune of about 35 odd trillion dollars of money into the economy that should have never been there. So the thing to remember is we have not necessarily just been obfuscating true supply demand in the last 6 or 8 months when we've been talking about a recession or inflation. We've been actually doing it since 2008. It's just that it's been building up in the system. So one of the things that we have to realize is that all of that money somehow needs to get destroyed in some way, shape, or form if the true economic equilibrium is meant to be found. What is true supply? What is true demand in the absence of government sloshing money around, trying to prop up things that should not be propped up, or buying votes, or all the grifts that these folks have engaged in the last, decade and a half have to get undone.
Though there is only a slim chance you haven't heard the term recession before, now plastered all over the news as it currently is, it is possible that you aren't entirely familiar with its premise. While a recession is most noticeable in a nation's GDP, it is also characterized by other indicators, including inflation, declining levels of income and revenue, a rising level of unemployment, reduced industrial production, and dampened wholesale retail sales, among other aspects. It is also important to note that when GDP consistently declines, it can be some time before people start to feel the hardship.
Look, here's the thing. I think we have to also be sensitive to the fact that the Fed operates on a certain class of data, and that data in the 21st century is pretty pathetic. Nick, you can probably find this, but there was an article, I think it was in the New York Times, that really walked through how CPI is calculated. And it's a bunch of people that work for the government that walk around with iPads, building relationships with local businesses in all these random places all around the country and asking them to, chit chat for 15 minutes and do these surveys. Now, you would have thought that in 2023 or 2022, what the government would have said to, Visa, MasterCard, American Express, all the payment rails, the banks and Stripe is send me a feed in the following structured way so that I can actually have an absolute precise sense of inflation, because inflation really only occurs when a good or a service trades hands for money, right? And you calculate what did that thing trade at the day before and what does it trade for today? So you could get an absolute precise sense of it. Instead, we do this random sampling thing and
subjective,
it's bad.
Humans, etc.
So if you read this article, your takeaway will be, oh my God, this is very rickety and it drives an enormous hammer that we use to try to manage the economy. That's the first thing. I think you need to buckle your seatbelt because the next 3, 4, 5 months of CPI will probably be very, very bad. 7, 8, 9%. Why? There are a handful of components that have gotten completely run away. Number one, the biggest one is rent. And so rent works on a 3-month lag. We're going to reintroduce what the true owner's equivalent rent is into CPI. So we can already forecast that CPI going up. Oil is at $105 a barrel. Russia is basically trying to break the back of Europe by now messing with their nat gas supplies. The German energy minister yesterday said that if that happens, it could be a contagion equivalent to Lehman Brothers with respect to energy. When you play all of these things out, what you have is unfortunately rampant runaway costs that really have no mechanism to get back in check in the absence of some real governmental changes. Our policy on this Ukraine-Russia war, how we intend to sort of work or cooperate or fight with China, all of these things have to get solved. So in the absence of that, prices are going to continue to go up. And so what does the Fed do? How does it throw away what little credibility it has left when there's 8 and 9% inflation prints and saying, we think we're done for right now? You can't do that. So they will overcorrect because there's just going to be so much pressure for them to act. All roads, I think, lead to lower equity prices. And I think what David said astutely is we've seen the first wave, but now it has to touch all these other areas.
There are many ways to predict a recession even before it happens, and some warning signs in particular can suggest that a recession is imminent. A looming economic crisis or recession may be indicated by signs in the data, such as an inverted yield curve, which typically denotes a significant risk to the economy, though unusually more short-term. Likewise, declining consumer confidence, a sharp decline in the stock market, rising unemployment, and a decline in the leading economic index, or LEI, are among other factors that can help in determining whether a nation or economy is about to face recession.
One of the most interesting canaries in the coal mine of all of this was 2 days ago and what happened to Facebook. And this sort of ties a lot of this stuff together in terms of like economics, inflation, asset prices, equities, tech. Then we can try to talk about non sort of, big tech. But everybody was saying, oh gosh, the market's going to rip on the open. We were closed for Juneteenth. And then on Tuesday, the market, the S&P was up like 250 basis points, 2.5%. And the NASDAQ was also up, call it maybe 300 basis points, roughly. But Facebook was down like 400 points, right? So it's a big spread. And why is that? And I was like, this makes no sense to me. What is going on with this price action? Everything was up. Apple was up. Google was up. And so I called around and, I was like, why is this happening? And this is the best explanation I got. When you look at who the incremental buyer is in the stock market, it tends to give you a sense of whether prices can go up or will continue to go down. And the poorest informed buyer tends to be retail. And the most informed buyer tends to be these very large institutional hedge funds, right? So there's a spectrum. And Facebook is an example of of big tech that is poorly owned by retail. So it's mostly owned by smart money. And the case that smart money makes for owning Facebook is that it's got an extremely cheap price to earnings ratio. So you must own it. And what they said was that they, looking at the tea leaves of consumer demand, what they actually re-underwrote was that actually it's not that the price to earnings was cheap, it's that the E in PE was just wrong. And if they pass through all of these increases in inflation and their earnings expectations into Facebook, it's actually more like fair value at a lower price. That's why they sold it so much on a day where the market was up.
First of all, it is important to note that the global crypto market, even at its all-time best, is worth only a fraction of the global economy. For more context, the crypto economy topped $3 trillion in market capitalization during November 2021, the highest it has ever recorded to date, though it sits below $1 trillion at press time. Clearly, there is a wide margin between the centralized and decentralized economies. As such, the crypto market may yet be too small to cause a recession in the global market by itself. On the other hand, if the traditional markets suffer the same fate, it could have cataclysmic consequences for crypto. In the end, the risk of exposure may vary depending on the market. The crypto market, just like the traditional market, is not exempt from the woes of economic crisis or recession. Naturally, those most affected in the crypto market during a window of recession would be the investors, both individuals and institutions alike.
The amount of grift by so many of these venture firms in running these sketchy deals where they would put in some amount of money. This is my understanding of the scam because it was explained to me. You put in a little bit of equity at some crazy price, and then you get these tokens, and apparently there's no, you can just sell these tokens day one. And so what happens is you price the equity, but it's meaningless because really what you're getting is the right to get some amount of these tokens. The price is crazy. You sell it and then you just kind of walk away. And apparently, you do these deals where you just rinse and repeat this thing.
So, do you agree with Chamath's outlook regarding turbulence going on in the economic markets? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video.